Welcome everybody. I Prakash Ranjan Sinha welcome you for the new session on financial literacy, and now we are going to talk about credit. Now let's see what we are going to cover in this topic. So we'll be talking about types of credits, revolving credit, EMI, equated monthly installment, flat and floating rate loans, loans and collaterals, advantages and disadvantages of loan and the loan provider. Now, first of all, what is credit? Let's try to understand it. Credit is, that means, in Hindi, we use the word called karj. All of us know it. So that's a credit. Let's say when we borrow something, we have to pay it. So that's a credit. All of us know one thing which is called credit card. So we buy a lot of things on credit. So there are so many things which we do through credits. So let's try to understand what are the different kinds of credits, how the payment is done, and the pros and cons of the different credits. So let's try to understand what is credit. When you borrow money to buy something. Now, whenever you are borrowing money, this is very, very important thing. Let's say, for example, somebody comes to me and says, give me 10,000 rupee. I'll pay you after 3 years. So now let's say he has taken 10,000 rupees, which he is going to pay me after 3 years. Now, what can happen? What are the risks? Now, first let's look from it. The first risk is maybe he will not pay me, which you all of us know it, default, which we have talked about in our earlier session. The second thing is, even if he doesn't default me, normally we see this thing, he's going to pay me back 10,000. Now, on notional term, both the 10,000 looks same, but when I'm receiving it, the purchasing power of money has got reduced. So this 10,000 is not of the same value of this 10,000. Maybe let's say it is somewhere about 9,000. So I have lost 1,000. But what has happened in between, he has used this money for some of his gain. Maybe he has bought something or used something or consumed something. So he has used this money for his advantage. Whereas by giving him 10,000, maybe I have lost an opportunity. Maybe opportunity of consuming it, maybe opportunity of investing. So it could be anything. Now, when I look in totality, whenever one person has given to somebody else, so there are two things. One, the money has been used, so there is a cost involved as well as there is a risk. So risk I've already explained to you, but what is the cost? The cost is the opportunity cost. I could have consumed that money, I could have invested that money, or maybe somebody else has. So that cost has to be compensated, as well as this risk also has to be compensated. And generally what happens, it is compensated in the form of the interest rate. So let's say if I take a loan from the bank for consumption, for buying car or buying house, so I pay interest over it. Now when bank also takes money from me in a form of deposit, they also compensate us. So we know that's the interest rate. So there are two parties involved. One is the borrower and the other one is a lender, which is a creditor. So when we see anybody who is borrowing money would like to pay as less as possible on the interest rate. Whereas anybody who is giving money, which is the lender, would like more again. So again, one person who is taking money would like to pay as less as possible, whereas the other person would like to pay more imposts. So again, that's the situation. That's why you find a very, very defined interest rate in a scenario. Now, this is a very, very important thing. Why I'm telling you? Because in our financial or economic system, there is a movement of circulation of money. There are some people who are short of money. There are some people who are having surplus money. Now, there will be exchange of this. The money, the person or the entity who is short of money, maybe, for example, consumer, corporate, they want money. They will take it from somebody who is having surplus of money. And the cost is, of course, the interest rate. So when you look at this scenario, borrower wants to pay as less as possible and lender wants to take as money as possible. what is important is in which market they are operating. Now, that's a very, very important, in which market they are operating. Now, we are having a very, very big country. We have got organized market also, and we have got unorganized market also. So organized market is regulated market, whereas unorganized market, it could be anything. For example, let me tell you, if somebody is taking money, particularly those who are living in a village, from the landlord, generally we must have seen in lot of Hindi movies, old age Hindi movies, Sahukar, landlord, Jamindar. Then there, the terms and conditions are decided by the stronger party, which was the lender, which was Jamindar. And there we have seen what happens. But over a period of time, this credit market has get organized. So that's why today we find a very, very mechanized way of this dealing with it. So borrower promises to pay in future. And what is that pay in future? So whatever I have borrowed money, let's say I have borrowed it for 3 years or 5 years. I have consumed that money for some purpose. So credit is always taken for some period, and of course it has to be paid back. And in between, since I'm using the money, I have to pay some interest over it. So loan amount plus interest, both is to be paid. Now let's look at it. What are the different types of credit? One is close-ended and the other one is open-ended. What is close-ended? For example, let's say I have purchased a house. The house is worth 2 crore. So I'm ready to shell out my 50 lakh from my own pocket, whereas I want 1.5 crore from the bank, let's say. So I go to the bank and I say I want 1.5 crore. So here it is a specific purpose. So purpose is very defined. I'm purchasing a house. I have taken 1.5 crore. That's one thing. Now again, till what time the whole loan has to be repaid? It could be 10 years, it could be 15 years, it could be 20 years, it could be 25 years. Again, that's something which will depend, again, between the bank and the loaner. So there is a time fixed. Now this 1.5 crore has been taken, which has to be paid, let's say, after 20 years. In total, in 20 years. Now, as I told you, anybody who has lent money, of course, has to be compensated for the risk, various risk, which is in a form of a interest. That has to be paid in between. So when I look at it, there are two components which has to be paid. One is the interest and the other is the principal amount which has been taken. So it's not that only you end up paying 1.5 crore. In fact, that is the principal. You have to add interest over it also. And this has to be paid in, let's say, monthly installment for 20 years. Next. That means this payment has to be done in installment. So this is what is a close-ended scheme. Taken one point of time for a very defined purpose. All the conditions are pre-decided before the disbursal of loan. Everything. What will be the interest rate? Till what time this loan has been given? That means the loan has to be paid by that. What will be the monthly amount? Oh, everything has been decided. So this is the close-ended. Now let's look at it. What is the open-ended? Open-ended is something called revolving. For example, it is revolving. It's revolving. The cycle is continuing. You take loan, you consume it, you pay off, you again take loan, you consume it, you pay off. So this is revolving. Continuous, everything is going. There is nothing like something called maturity. So it continues that. But here also, if you look at it, you have taken a fixed amount. That's very clear. But here also, since it is revolving, there has to be some maximum ceiling. You cannot just give anything. So again, it is decided between the two entities. For example, credit card is a very, very live example for that. But here also, again, depending upon the income, credit worthiness, all other factors, maximum ceiling is there. What you can take or what you can use. So there is no restriction, you can withdraw as and when, you can consume as and when. Example is credit card and overdraft. So let's look at the type of credits: revolving lines of credit, equated monthly installment, fixed principal repayment, flexible principal repayment, flat rate, floating rate, loan with collateral, and loan without collateral. So close-ended and open-ended, which was revolving, we have seen. Now, ultimately, it has to be paid. And here, there are two components which has to be paid. One is the principal, and the other one is the interest. Both has to be paid. But now the question is how it has to be paid. So let's look at this equated monthly installment. So for example, same, like I'll go back again. Let's say 1.5 crore has been taken. Which has to be paid in 20 years, which becomes 240 months. Let's say the interest rate is 12% per annum. So what will happen in an equated monthly installment? A fixed amount, a constant amount has to be paid. So how it is done? Now this, since it is going to be paid on a monthly basis, this fixed amount has to be decided on a monthly basis. So the first thing is you are going to calculate what will be the interest per month. So let's say if it is 12%, 12% divided by 12, it becomes 1%. So this is the 1% which you have taken. Now, this 1% will be applicable on 1.5 crore. So what will be the interest payment? Let's put it this way. It will be 1% of 1.5 crore, which becomes, so now the interest payment has to be paid of 1.5 crore, which I have taken as a loan. So 1% of 1.5 crore becomes 1.5 lakh. Now this is just the interest rate, please. Now it is very clear. Now 1.5 lakh is the interest payment. But principal also has to be repaid. So let's say it is agreed between the two parties on a monthly basis. They are going to pay 2 lakh. So 2 lakh is the payment which is done. Now of this 2 lakh, goes towards principal payment, and 1.5 lakh is towards interest payment. So this has been decided for the first month. Now let's go to the second month. Since 50,000 has been paid, the principal will not remain the same. It will get reduced. So 1.5 crore minus 50,000, whatever has been paid, gets reduced. Now next month when you are calculating this interest, it will be 1% of 1.5 crore less 50,000. So that means now the principal has got reduced. So what is going to happen? Over a period of time, you will see that the interest payment keeps on decreasing because you are going to pay 2 lakh always, which is principal plus interest. So this 2 lakh which you are paying on every month comprises of payment towards principal as well as interest. Now since your principal is getting reduced, as we have seen in the first month, so 1% of the outstanding principal will be always less. So what is going to happen over a period of time? Let's say, if I look at it over a period of time, what is going to happen? Your interest amount will be decreasing slowly. whereas the principal amount which you are paying is more, though the total payment is 2 lakh. So maybe, just for example, I can tell you, next month you are paying the same thing, but interest may be, let's say, 1.35 lakh. So 2 lakh minus 1.35 lakh, that means 0.65 lakh is the money which is going out of your principal. So this is how it happens in a equated monthly installment. Now let's go further and see what is revolving line of credit. So as I told you earlier, it's nothing but it's revolving. It does not end here, it is revolving. So that means I'm taking money constantly, I'm borrowing, I'm using, consuming, making payment, all these things are happening. The cycle is continuing again and again. Whenever, let's say for example, credit card is a one example, let's say, which is a revolving line of credit. So it's not that you can borrow anything or you can consume anything. Again, depending upon the credit worthiness, income, expenses, assets, again, on the financial strength of the individual, every bank, whenever they are issuing the credit card, they put some limit. That's why you will find different type of credit cards, silver, gold, platinum. So you have got different type of credit card which you take it. So what is first thing is the credit utilization. For example, let's say if somebody is having a 1 lakh as a limit, and if he has used it only 80,000, so his credit utilization is 80%. So it has to be well within the maximum permissible limit which is there. Interest frequency. Now, since you are using and consuming somebody else's money, you are buying things on credit, that means at any point of time, there is some outstanding balance which is against your name. So interest has to be calculated. Now, this interest, we need to remember, is calculated on a daily basis. Though you will be told that the interest rate, let's say, is 24% or something, but it is calculated on the daily basis on the outstanding amount, whatever is there. So let's say if the outstanding amount is 50,000, it will be based on that. Next day, let's say if you have done a purchase of 60, another 10,000. So this outstanding amount becomes 60,000. So the interest will be calculated on 60,000. So though we pay on a monthly basis, but this calculation is done on a daily basis. So the previous day interest, which we have not paid, that also get added on. So that's why if you look at it, the interest rate is quite high in credit card. It's quite high. So this interest frequency. Overutilization charges. Now you have been already given some limits. But at times, if somebody inadvertently or maybe deliberately, I don't know, if he has consumed or used something more than what he has, the limit which has been given to him, then bank will be charging something over it for whatever. Now, this is one aspect. The other thing which is also very, very equally important is your credit utilization should also be a good yardstick to judge about your credit score. More the utilization, it damages the credit score. That's one part. Because credit score is a very, very important thing, which we are going to talk later. And if there is a overutilization, then of course, it is taken more on the negative side. So overutilization should always be avoided. That's first thing. Now there is a late payment fee. So whenever we take a credit card, there is a due date. Maybe it is 5th of the month or 7th of the month or 10th of the month again. So the whatever amount which is there to be paid, that has to be paid by that time. In case somebody has not paid it by that time, then interest rate is charged over it. So you get some interest rate charge over it. And interest rate is quite high. In case somebody is able to pay before the due date, then that person is not liable to pay any interest. So these are the features of the evolving line of a credit. Now let's talk of the equated monthly installment. EMI. Now, as the name itself states, first of all, monthly, that means to be paid on a monthly basis. And the word is equated, that means the same amount to be paid on a monthly basis, whatever it may be. Now, let's say, for example, somebody has taken a loan of 20 lakh, let's say, from the bank. Let's say for purchase of house. So this is a loan which somebody has taken it. Assuming that the interest rate is 12% per annum. That means 1 month interest rate is 1%. 12% divided by 12 is 1%. Now, in a case of equated monthly installment, you are paying the same amount on a monthly basis. So what is going to happen? Fixed amount on a specified date. That's decided. So how it is calculated? Now you have taken a loan of 20 lakh. The repayment period is also decided. So maybe this loan you are going to pay it, let's say, in next 10 years, which is 120 month. So let's say the bank is going to do a calculation. So in the EMI, there are two components which you are paying. The principal, so here you have taken 20 lakh, so that becomes the starting point, and the interest, because you have to pay the interest. So what will be done? The first you are going to calculate interest payment first month, let's say, first month. So it is 1% of 20 lakh, which is equal to 20,000. So this is the interest payment which you have to pay. Now, the principal also has to be paid in the EMI. So let's say it has been decided that the person will be paying 30,000. Let's say, for example. So 30,000, if it is to be paid, then it is 10,000, which is principal, plus 20,000, which is the interest. So this is the first month, let's say. Now this 30,000 is fixed. Let's say if it is calculated 30,000, 70,000. So this becomes the outstanding balance because 30,000 has been paid. So after first month, what we see, that 30,000 has been paid, but that 30,000 comprises of 10,000 as a principal payment amount and 20,000 is the interest. Now next month also, the person is going to pay the same 30,000. This 30,000 will remain the same. But since he has already paid 10,000 out of 20 lakh, so next month it will be 19.90. So this is the outstanding balance. Now again, first the interest payment is calculated, which is same 1% of 19.90. So whatever it comes, that 30,000 minus that interest, the remaining will become the principal. So over a period of time, what we are going to say, though 30,000 remains a constant amount, but the principal and interest both are being paid. But since the outstanding amount is slowly reducing and you are calculating interest over that, your interest amount of the total EMI, which is 30,000, is reducing. So what happens? Principal amount increases, whereas interest amount decreases from the 30,000. That means over a period of time, more and more principal is getting reduced from the outstanding amount. And the interest amount is slowly reducing. So more and more principal is over a period of time gets paid and interest amount gets reduced. But you continue to pay 30,000 till all the payment has been cleared. So this is what is the how EMI is calculated. So repayment within a period. So as we have seen, and again this, let me tell you, the interest rate is again decided by the bank. Maybe the individual can influence, maybe there can be some. So for example, let's say somebody is not willing to pay 12% because maybe that is too high. Because ultimately this 12% is more or less fixed. What it is going to matter to him is in how many period it has to be paid, because that is going to decide this thing. So maybe that person can say, maybe make it 15 years, let's say, and I'll pay it off in 15 years. So what will happen? This 30,000 will get reduced. So again, this is the flexibility maybe the investor or the person who has borrowed the money is having, so that with after talking to bank, those things can be arranged. So, but whenever the loan is taken, the conditions are more or less fixed. The interest rate, by what time the whole amount has to be paid, and what monthly EMI to be paid. So everything is fixed. Over a period of time, though this at times, though there is a flexibility, again, depending upon the bank, they can give you this flexibility. If you want to restructure your loan, maybe you want to again change the period, so that can be done. So payment starts after the disbursal of loan, and it includes both interest as well as principal. Now let's look at it. The another way of looking at it is fixed principal prepayment. So as the name stands, same example, let's say as I gave you, let's say 30,000. For example, let's say if somebody has to pay 30,000. Now in this, what can happen? Again, there are two components. One is the principal and the other one is the interest. So here we have seen both the principal as well as the interest were changing on every month, but the EMI continued to be the same, 30,000. In a case of a fixed principal repayment, interest rate is fixed, that is known. But what is going to happen? The principal amount which has to be paid is fixed. For example, let's say the person decides to pay 20,000, let's say for example, first month. Second month also 20,000. Third month also 20,000. So this is the principal which is fixed. So here what is going to happen? Again, the whatever loan you have taken, every month you are paying off a fixed principal. And after the payment of principal, some outstanding balance is left. So again, depending upon the interest rate, maybe it could be 10%, it could be 8%, or it could be 12%. Again, whatever it is, that will be taken on the outstanding principal. And of course, it has to be paid with some interest. It has to be paid with some interest. It has to be paid with some interest amount. But the difference is here, this interest amount will not be the same. So maybe it can be interest 1, interest 2, interest 3. This can keep on varying. And again, when you total both, let's say, this will also vary. So let's say amount 1. Again, this will also vary. This could be amount 2. This could be amount 3. So this is another way of making the payment, where principal is known, whereas the interest will be on the outstanding. Now here, there is a big difference between the EMI and the fixed principal payment. Because in a EMI, I know, for example, I have to pay 25,000 or 30,000 or 40,000. That is something which is known. The cash flow is known. But here, since A1 is different from A2 to A3, that means every month the cash outgo from my pocket or from a bank account will be different. So that is one thing. So fixed amount of the principal is to be paid every year. Outstanding loan will decrease, of course, because you are paying, so it is going to decrease. Interest will be on the outstanding amount. As it is going to decrease, of course, interest will be. So interest is also going to reduce over a period of time. And so if you look at it, this A1, A2, A3, this will also keep on decreasing. So monthly amount reduces every month. So this is fixed principal repayment. Now, this is something maybe people can use it, particularly, let's say, if they are not very sure of their cash flow. Maybe. So maybe now they know that this is what I have to pay, and over a period of time it is going to reduce. So maybe they can use this method. So when we look at the fixed principal repayment, I mean, we have got EMI option. I can go for that also for this. But generally, I mean, this is good for something called, let's say, education loan. Education loan. Now, why I'm telling you this thing? Because generally, our banks are very flexible as far as giving education loan is concerned. Let's say, for example, somebody goes with his parents for taking education loan, and the child is going for BTech. So after 4 years, he is going to graduate and he is going to get engineering degree. So many times, what happens? The banks give them a flexibility. Okay, this loan has to be paid after 4 years or something like that. So I can decide about that. So that's one part. The second thing is, this principal is something which I have to decide. So maybe I decide I don't want to pay anything principal for that period. Let's say the parent decide, okay, we don't want to pay principal for the first 4 years because amount is big. We'll pay it later on. But if interest is something which is going to be calculated from day one, that's one thing. You cannot give rules. And interest will always be calculated on the outstanding amount which you have taken. So in that case, what happens, or the best course of action it could be, you keep on paying the interest, which will not be a very big amount, let's say. So for the first 4 years, the wise move is always, you keep on paying the interest. Because what will happen, if you don't pay the interest, then of course, interest over interest over interest, we all know the compounding effect, the amount will become too big. Because you have already taken a capital, a principal, so that's there, a loan is there. So the best move is, the parents can do, they keep on paying the interest. That means that interest over interest is not adding. What happens the moment the child gets a job, then both parents and child who is now in job, together, they can start paying principal. This is again something which the bank has to agree to. But they will start paying principal and they start paying a big amount, then very soon they will be able to pay back all their loans. So again, the question is not whether I should be going for EMI or fixed principal prepayment. Again, it all depends upon the cash flow situation. And as I told you, this looks good for the education loan, where you can defer it for some time if the bank agrees to for that. And then you keep on paying interest. And later on, if the parents are also employed as well as the child also get employed, so you can pay a big amount of principal, and maybe you can clear your loan much faster than what you could have thought of. Now let's look at the another option, which is flexible principal repayment. So as we are saying, it is flexible principal. For example, again, but this is particularly true for somebody who are young earners. Maybe they have got more expenses and people have taken some consumer loan. Let's say, for example, maybe they have taken a bicycle loan. Maybe they have taken motorcycle loan, TV loan or fridge loan, whatever it may be. So there, what is going to happen? You can go for a flexible principal repayment. So what is going to happen? Again, there is some outstanding amount which you have taken a loan. You have to pay the principal as well as the interest on your outstanding amount. The rate of interest is decided. Everything is there. But here, the difference is, interest has to be paid mandatorily, whatever it is. But principal payment is again flexible. So maybe whatever cash flow which you are having at your end, you keep on paying. So let's say in first month, second month, third month, you pay a interest one. Second month, now again, let's say you have not paid any principal. So here the principal is zero. Let's say, for example, principal is zero. Now, since you have not paid anything out of principal, only interest, so the outstanding will remain the same. Let's say next month again, you have paid. Since the principal remains the same interest amount has been paid. Maybe you have paid, let's say, 30,000. So this 30,000 is going to make your outstanding loan amount less. Now, when third month you are making the payment, again the interest will be calculated on the outstanding, which will be less because it has got reduced. So maybe it could be I2. Now, again, depending upon your cash flow, maybe you are paying 5,000. So here what is happening? Interest has to be paid mandatorily on the outstanding balance, whatever is there before the month beginning. Whereas principal payment is flexible. So some month maybe you are paying 30,000, some month you are paying 5,000, maybe another month you are paying 20,000, maybe you are paying no payment. So that's the thing is there. So this is helpful for those people where there is a cash flow issue. And as I told you, maybe particularly it is good for some beginners who have just got into job and they take consumer loan, mobile loan, TV, fridge, all those loans. So maybe they can do it. So here the duration is again managed by the borrower. By what time I want to pay the whole loan. Early repayment option is also there. So maybe in one go, let's say if somebody decides the outstanding loan is not big amount, let's say it is left only 1 lakh is left or 2 lakh is left. Maybe in one go, he can pay it. Let's say he gets a very, very good bonus. The employee is very good. The employer is very happy. And the employer is has given him a bonus of 2 lakh. So in one go, he can clear this outstanding loan. So again, this is another way of taking a loan and managing the loan. So as we have seen, you have got different ways of making the payment. And whether you want to go for EMI or you want to go for a fixed principal or a flexible principal, it again depends upon the loan, which amount which you have taken, how quickly you want to pay off the loan, and also on the cash flow position of the thing. So depending upon the things, of course, generally if the amount is very big and people want to know that this is something which I have to pay on a very regular basis, they go for EMI. But if the loan amount is less, then better you can go for something called fixed amount, and you can pay it also as soon as possible. And if there is a cash flow situation is there, then flexible principal prepayment is a better option. So again, depending upon the situation, the income, cash flow situation, all these things, the person should decide which way the loan he should be taking and how should be making the payment. Now let's talk of interest rate which you have to pay, because if you have taken loan, interest has to be paid. So let's look at the flat rate loan, which is nothing but fixed. So here what is going to happen? Interest rate is fixed. So let's say, for example, you have taken a home loan and you want to pay it for next 20 years. That means 240 month. So when you have taken the loan, at that time only, that interest rate is fixed. This is fixed. Whatever is there at that point of time, it could be 8%, it could be 9%, it could be 10%, it is fixed. And this interest is on the entire loan amount. So whatever, when I'm saying loan amount, means outstanding loan amount which is there. So let's say if when you took it was 1.5 crore, so it will be on that. Let's say after a year, it is 1.1 crore, then it will be on this. Let's say after some time, it is 50 lakh, then it will be on that. But the same interest will be on the outstanding loan. Now, when we are looking at whether it's costly or cheaper, then we have to always look at in relative to something. Now, since here the bank is giving you loan for a very longer period of time, they are taking more risk. So that's why you will find the interest rate here is slightly on the higher side. Because there is another way also where you can take the loan, that is called floating rate. So it is higher than the floating rate loans because they are committing their money to you, or they have given you money for a very, very long period of time. And in this between, anything can happen. Interest rate can go up, down. So many things are there. So that's why it is slightly expensive. Now, it is very easy to track and calculate. Now, since I know I have to pay, let's say 9%. So I can easily calculate how much I have to pay, whatever is the outstanding balance. So it is easy to calculate. So in other words, it helps me to know how much I'll be paying it on a monthly basis. Now, the other is floating rate loan, where the interest rate is not fixed. It keeps on changing. Now, when we look at the floating rate, where the interest rate keeps on changing, that means, let's say today it is 7%. For example, if the interest rate within the economy increases, then it will not remain 7%. It can go to 8% or 8.5% or anything. It will go up. Let's say if the interest rate goes down, then it can come down also. Maybe it can become 6.5% or 6%. That means it is not fixed. So again, the interest rate keeps on changing here. So here what happens, whenever the interest rate changes, because when you have taken a loan, the tenor has been fixed, the EMI has been fixed. But what can happen? This can be readjusted. This both EMI and tenor can be readjusted, keeping this thing in mind. Longer the term, more variation is the interest rate. For example, let's say if I have taken the interest rate I have taken a loan for 20 years. If I take last 20 years, let's see, and I just look at the interest rate changes, how many times it has happened? It has happened so many times. So it will keep on changing on a very, very regular basis. So as and when there will be change, the cash flow, outflow will also be keep on changing. So longer the term, more variation is it. Now, when I look at it, what is good for the lender and what is good for the borrower? Now, it's a very, very important thing. This is better in a low interest rate scenario for the lender. Why? For example, let's say if the inflation is very low, let's say somewhere about 4%. And generally, we know that the interest rate in our economy is more or less in line with the interest rate, or maybe treasury bill or G-Sec rate. So more in line with that. Now, let's say if the inflation rate is very low, let's say 4%, then you will find the rate is also less. Now, what will happen if the bank, if it is 4%, and let's say the bank has given at 6%, let's say, for example. But tomorrow, let's say if inflation goes up and changes, let's say this is a change which I'm talking about, inflation changes and inflation becomes 7%, then it is not advantageous to the lender, to the bank. So that's why floating rate loan is always set on some benchmark. It could be inflation, it could be repo rate, it could be anything. It could be, let's say, G-Sec rate or T-bill rate. It is on some benchmark. So as the benchmark changes, let's say if the benchmark also increases, this will also increase. Maybe this will become 8%. But if the bank continues to give, let's say, at 4% throughout, then bank will be the loser. So it is very good for the lender, particularly all time, I would say. But since in a low interest rate scenario, if you give something fixed, then of course this is not going to help the lender. Now let's talk from the borrower point of view. What is good for me, fixed or flexible? Now I'll give you a perspective. What is the perspective? First of all, let's say home loan I take. Home loan. Let's say I have taken a flat and I have taken a loan of 2 crore, which I want to pay in 25 years. Now, if I visualize the interest rate scenario going forward, what will be the interest rate? Let's say long-term interest rate, 25 years down the line. In all probabilities, as our economy is going to improve, grow, our interest rate will also go down. So let's say if I go for something at a high interest rate, then down the line, it's not going to help me. So for a borrower, floating rate loan is good. So for a borrower, let's say the floating rate loan is good if you are taking for a long term and if you are taking at a high interest rate. For example, let's say if a borrower goes for fixed interest rate and the interest rate is on the higher side, let's say 12%. And after some years, let's say if this interest rate goes down to 9%, then you are still stuck up paying 12%. So floating rate will always give you this advantage. Yes, but if you are borrowed at a low interest rate scenario, let's say if the interest rate is low and if you want to go for a fixed for a long time, then it is very advantageous for the borrower. But the question is, why will bank go for it? Definitely bank is going to suffer a loss. That's why bank generally, they also very clear what to go for it. So generally they will offer you fixed interest rate only when the interest rate is high. Bank will never offer you fixed interest rate when the interest rate is low. They will always, either you go for floating rate, irrespective of whichever direction the interest rate is moving or which it is, or if the interest rate is high, bank will offer you high fixed interest rate for a long-term loan. So we need to understand again the implication of these things, what will be on the payment cycle and also the interest rate which I am going to pay. Now, whenever you are taking loan, as we have talked, anybody who is giving loan, that means giving his money, is taking a risk. So one way of compensation of the risk is interest rate, which they are taking. But the other way is also what happens tomorrow if you are not able to pay back the loan. You default. Then let's say the outstanding amount is very big. Then forget about the interest, because once you have defaulted, the interest payment is also not going to come. So what happens? Loan are issued with collateral and without collateral. So with collateral means some security is taken against which the loan is given. Now let's say, for example, many of us go and take home loan. But whenever we take a home loan, that home against which we have taken the loan gets hypothecated or mortgaged with the bank. So the loan papers, the home owner papers, the property papers, they are kept with the bank. And nobody can sell it until and unless we pay back the loan and net clear our dues, all our outstanding dues. Let's say if somebody has taken a car loan. Now again that car which he has taken, purchased it, taking the loan, that is gets hypothecated. So that person cannot sell the car until and unless he has not cleared his loan, has not paid all these things. So most loans require collateral. Even the companies, businesses who are taking loans, they are also giving some or the other collateral, which is nothing, a safeguard against in case there is a default. Now, but the larger question is why bank is taking collateral. Now that's one thing. Because tomorrow, unfortunately, let's say, if the entity who has taken loan has not been able to pay back, then this collateral can be sold and recovery can be done. Now, another thing which is very, very important, banks are giving loan, but it's the depositor money which is at risk. We might think that bank's money is at risk. No, ultimately it's the depositor money which is at risk. And since they have taken deposit from different people, maybe 1 year, 3 year, 5 year, whatever the terms and condition may be, they have to pay back also. So they need something to safeguard the interest. That means security against the risk of default, which is in a form of either physical, material, or financial guarantee. Different interest rate with or without collateral. Now, there are certain loans which are given without any collateral also. For example, let's say personal loan. It's not given with any collateral, but there also the biggest collateral is the credit worthiness of the person. So they will also look at it. What is the income level? What asset he possesses? What are his track record, his CIBIL score, his credit worthiness? And based on that, that loan is also given. And as we have talked earlier, how much he is consuming it? What is the utilization ratio? Is he paying interest on time or not? Is clearing all his outstanding loan on time or not? So again, these are the factors which has to be seen. So let us look at it. So what are the loans and collateral? For example, let's say if you are taking credit card, overdraft, no collateral is required. Credit worthiness becomes the thing. In case of education loan, no collateral up to a certain amount. It's not that key, it is all. So let's say in case you take a big amount, up to some amount, there is no collateral. But let's say beyond a limit, if somebody is taking a big loan, then something has to be given as a collateral. Maybe parents are having their house or property, so that will be shown land, or maybe some financial assets like investment, that will be shown as a collateral. Personal loan, post-dated checks are there. And again, as I told you, it's done more on a credit worthiness. Car loan, the vehicle itself gets hypothecated. Home loan, house gets mortgaged. If you are taking a gold loan, the gold itself gets pledged. Consumer loan, whatever consumer loan you are taking, let's say, for example, you are taking TV, fridge, or whatever it may be, that gets pledged. Now, let's look at taking a loan. Should somebody take a loan or not? Now, it's a very, very important thing to understand. All loans are not bad. It's not a question of taking loan. It's the question of taking loan for what? So if I'm taking a loan also, let's say, I have to look at it for what? For what? If it is for asset creation, then it cannot be said bad. Let's say, for example, if I'm taking loan for purchasing a house, or maybe even if I'm taking loan for buying a car, which is again, it's helping me to enjoy with my family. But there also, what is another important is how much. So this is also equally important. So you have to do a cost benefit analysis. For what I am taking? Is it for asset creation? Let's say, for example, I am taking a personal loan for going and enjoying holiday, going to a vacation with my family. Let's say I want to go to Switzerland or maybe to Europe, 15 days trip, and I've taken 10 lakh. Now again, I have not created some asset. I have not done it. I have not done some investment. So it is not adding any value. Yes, maybe I may have enjoyed with my family, but ultimately it has not added any value. So it's very, very important. Whatever you are taking, it should be of some productive purpose. Very important. So let's say somebody has taken loan for education. But again, when I look at it, the parents have taken loan for their children for their higher education. Maybe child wants to go and study in USA. But though it is a borrowing, a loan, if I look from the other way around, it is an investment. So here the parents have invested for better future of their child. And tomorrow the child who is going to get the best of education from some, let's say, premier college, or he's going to get some good degree, then he will get a good job. He will earn good amount of money. And yes, he will be able to pay back his loan also. So whenever you are taking the loan, it's very, very important, the purpose, for what. And the other thing is also how much. Now, this is also very, very important. Because even the purpose is good, maybe you should be able to pay back. That's also equally very important. I cannot take any loan. For example, let's say home loan, most of us take it. But if I take, let's say, 50 crore, then that is a cost on my head. I have to pay it. Now, if I fail to pay it, then what's going to happen? So loan also should be taken up till to the extent what you can repay timely and without any discomfort. So it is very, very important to understand. You need to decide need versus want. Now, need is something, maybe it's something which I require it for my survival, or maybe for livelihood, or maybe which is going to make my life comfortable. Let's say if I'm having my own house, rather than every time moving from one house to another house, that's a rented house. So again, need has to be looked. But want is something which is called a desire. And we had a session where I told you about important and not important. And I told very clearly, the thing, if I don't have it, or if I don't do it, is going to harm me. That's important. If it is not going to harm me, it's not important. So want is a desire, for example. Yes, I want to buy a car. Yes, car may be looking as a need, because car is going to help me. If I want to go anywhere within the city, I don't need to wait for cab or public transport or something like that. But again, there also, whether I want to go for a big car or a small car. Because there are cars which I can purchase it maybe in 3 or 4 lakhs. There are cars which I can purchase it at 40 lakhs, 50 lakhs. So again, how much? That comes into play. Loan for vacation, which I already told you. And above all, whatever you are taking, it all depends upon your financial ability, your income, and how quickly or how you can pay back the loan, whatever you have taken, on time, without any default, all these things. So this is also very important, the repayment capability. Now, what are the advantages and disadvantages of the loan? We have already seen it. There are these numbers of loan: credit card, home loan, education loan, mudra loan, business loan. And if you look at it, home loan, education loan, we have already talked about it. Mudra loan is given to set up a business. Business loan, again, for big corporates. So it helps you to create wealth. When I'm saying wealth, what do I mean by that? Let's say, for example, today somebody wants to invest in equity, and the rate of return which is going to get in long term is, let's say, 15%. So rather than redeeming all his investment for purchase of something, he's taking some loan, which he's going to pay, let's say, at a 10%. So this extra 5%, which is again difference between these two, maybe adds to his wealth. So I'm able to grow my money. Maybe it helps me. But again, here it is very clear that the ROI, return on investment, should be greater than the rate of borrowing. It should be greater than that. Then only it's going to help you. Create a asset, long-term personal assets like home. Disciplined approach for creating assets through regular repayment. Now, that's another thing. I cannot, let's say, for example, I want to purchase a house and the house is worth, let's say, 1 crore rupee. And if I don't want to take loan, that means I have to slowly accumulate that money. Maybe it will take another 5 years or 10 years, let's see. By the time I have already accumulated, let's say, maybe the cost of that property, which I was thinking of taking, is not 1 crore. Now, this will also increase to, let's say, it becomes 2 crore. That means I'm in a situation where I'm just chasing that asset. I'm not able to acquire it. So those things do happen. All of us know it, because the prices of the property also increases over a period of time. So left with no other choice, I have to take loan, particularly for something like home loan or something like that. But as I told you again, the question is not of taking loan. For what? The purpose, and also the amount is also equally important. Yes, you want to take home loan, but it should not be something which is beyond your reach. And we have talked about one proverb earlier, which again I am going to repeat it, which is in Hindi. पांव उतना ही पसारिए जितना लंबी चादर हो, चादर से ज्यादा अपनी पांव को मत पसारिए. Be within your limits. That's the thing. Now let's look at the loan disadvantage. More interest is paid than benefit received. It can happen, yes. Our expenses increases because of interest payment. Particularly this is true for personal loan, vehicle loan, all those things. Expenses will increase because interest, if you're taking more loan, more payment has to be given. You're left with very little surplus. Asset value becomes zero before the loan tenure. I mean, this is particularly true for car, bike loan, because there the depreciation happens very fast. So, but yes, those things might be required, maybe because it gives you comfort, but again, it has to be within reasonable limit. Prevents us from increasing our net worth in case I have taken more loan. May lead us to debt trap. Debt trap means getting into a situation where I'm not able to pay all my outstanding loan. That cycle is revolving, where every day, every time, there is something on my head. And it's very, very difficult to get out of it because the quantum of loan has gone up. I mean, you must have seen some of the countries, for example, I mean, just some years back, what was the situation of Sri Lanka? They had got into a debt trap. So this was for the nation, but again, even for individuals also it can happen. So one should never get into a debt trap. Always do whatever which is within your capacity, within your limits. Don't do anything which is beyond your capacity, beyond your limit. So the question is not taking loan is good or bad. The question is, for what I'm taking, is it really going to add some value in my life or my children's life? And the second thing is, even if it is, let's say, advantageous, or that thing is something which is good for me, productive, how much loan I'm taking? So how much is something which I have to pay at some stage of my life? So it should be within my limit. So who are the loan providers? You have got microfinance, housing finance, bank, NBFC. So generally you will find these are the regulated entities. But of these, banks' rate of interest, particularly let's say if I'm talking about home loan, is generally lesser than NBFCs and housing finance. So these are the regulated ones. When I'm saying regulated ones, they have got a regulated structure. They are somewhat registered with government authorities. They are working. Everything is being monitored also by RBI and certain others government bodies. So they are not regulated. They are not something which they can offer anything. But there are a lot of unregulated loan providers also. For example, chit funds. Maybe chit fund is something like a group of people. They form an association where every month everybody is contributing some fixed amount, and some lottery is taken out and some lucky winner gets that amount. So within chit fund also there are some maybe which are more organized. For example, let's say there is a company. So the company employs, maybe they are created some chit fund. Maybe I won't say it is as regulated as, let's say, bank or NBFCs, but maybe the company is also keeping a watch on that. But chit fund created by some close friends, let's say neighbors, housing society members, can be very risky. Money lenders, we have seen it in our economic system, particularly at a smaller location. The jamindars, the big landlords, they give money on credit to poor farmers. And as I told you earlier, we have seen in a lot of Hindi movies what happens. P2P platform, which is called peer-to-peer platforms. So there are a lot of platforms also where there are different members who are there, and they also give lending happens. So people contribute, and then that amount is further lent to other people. Own broker, for example, let's say sahukar, which is Hindi word, we all of us know it. Maybe somebody goes and gives jewelry, and that against that jewelry somebody is giving some money. So these are the pawn brokers. So unregulated also you have got regulated loan providers also in our system. Before I go for takeaway, I would just like to talk about something. Let's say credit card, because credit card is something which I think most of us do carry. Now, credit card has got its own advantages and disadvantages. Both it has got. The advantages is that it helps us to spend when we are not having money in our pocket. So many times such situation comes when maybe I'm short of cash or I'm not having something in my hand, but I want to spend something. So credit card comes very handy in that situation. As I told you, let's say you want to buy a TV or fridge. Let's say suddenly there is a breakdown of some consumer item. Now, you're not having that much of money in your pocket at that point of time. So maybe you can go and buy and purchase it. So it helps you certain times. But the disadvantage of credit card is many times we overspend also. So one example which I gave you earlier, discount sale is happening. Buy one, get third one free. So we go and purchase through credit card. So that means overspending also happens. Now, in a credit card, there is of course some limit. And if you are spending within that limit, if you are making payment on time, if you are not carrying over your outstanding amount or due, then that's good. But if you are not paying on time, if you are carrying over, then you end up paying a good interest over that. Now, credit card is very, very important thing for each one of you to understand. For the very simple reason, many of you are very young, maybe a student, or maybe very soon you are going to start earning. Now, today, lot of banks, and there are so many entities who keep on offering credit card to you. Now, we think if I'm carrying 4, 5, 6 credit card, it gives a very, very good impression to whosoever is looking at me. But if I'm having 4, 5, 6 credit card with me, then again there is a temptation to spend more also is there. So maybe I'll be spending something from one credit card, spending from something from other. But if I total all, then it becomes big. So again, there is advice, strict advice. Yes, credit card is good. You should have it, but don't have more than 2 or maximum 3. Even if any of the bank is approaching you, they might be telling you so many positive things about it. But ultimately, by the end of the day, whatever you purchase on credit, it's a cost which you have to pay. So better, yes, to have some credit card, but not beyond the limit. So my suggestion will be always have a very, very, very limited number of credit cards, maximum 2 or 3. So let's look at it. What are the key takeaways from the today's session? Is one, understanding term of the loan. So how much I require, how I want to pay, depending upon my cash flow requirement, whether I want to fix principal or may I want to pay flexible principal, again, depending upon my cash flow situation. Do cost benefit analysis. That's very, very important. Whenever you are taking loan, it's not only the principal amount, the interest rate, by what time the whole loan will be repaid, how much monthly it will be going. There are so many other things also. For example, let's say you in one go you want to clear the loan. Maybe you have got some big amount, you want to pay part of the loan. Is it allowed? In case it is allowed also, do they impose some penalty or charges over it? Or is there any time limit within which you can do it or within which you cannot do it? So you need to understand all those things. Very important. Cost benefit analysis. Terms and condition has to be read, understood, interpreted very, very correctly. Know which type of loan to avoid. Now that's very, very important. So any loan which you are taking for asset creation as an investment, in case of an education loan, is good. Any loan which you are taking, which is just going to help you enjoy your life, personal loan, vacation, going on a vacation. So those things, avoid it. One should not be taking it. Evaluate advantages and disadvantages of whatever loan you are taking. Terms and condition. Credit card, which I told you. Always, for everything, there is a positive side, there is a negative side. So we should be knowing both the positive as well as negative side. Take loan from the regulated entities only. That's very, very important. Why? Because if you take loan from unregulated one, which generally they do mis-selling, what happens? Let me tell you. For example, if somebody has not got loan from a regulated entity because of any other reason, that person approaches to unregulated entities. They will give you a loan, but maybe at a higher interest rate. Now, if it is a compulsion for you to take loan, again, depending upon your need requirement, you will go for it. But the bigger question is, why I am being forced to go for unregulated one? That's the question. If everything was good, the regulated entities, let's say bank in particular, they will definitely give me loan. So I need to look at it why a situation has come where I have to go to unregulated one. Because the temptation will be there. Let's say, for example, there are many people who will say, boss, you have to do a lot of paperwork here. I mean, you are hardly going to get any paperwork. I'll come to your place and do everything for you. Maybe you can think, yes, it's an convenience, but this convenience is coming at some cost. Your data is maybe not be secret. Is it going to affect your CIBIL score in some way? You don't know. Because today, CIBIL score is something which is very, very important. For example, let's say just few days back, a news was there for the banking recruitment. This was for other than State Bank of India. The authority which is recruiting people for the banking job, they are going to evaluate the CIBIL score. And they have set a parameter also. Below this, maybe they will not be considered. Above this, they might be considered. So again, these are the things. Whatever you can get easily or free may not be good. So always take loan from regulated entities and avoid, or other I would say, don't take from the unregulated ones. Now I want to add one more thing before I finish this session is how you can better your net worth or increase your net worth by better loan management. I'll just give you an example. Let's say home loan. Now anybody, let's say, who has just started his job or maybe has spent some years in job, would like to have their own home. So they take a home loan. And generally, whatever amount they take it, the period may be, let's say, 20 years, or it could be, let's say, 25, or it could be 30. Again, it's a long period, let's say. Now, you have taken a loan. What happens over a period of time, interest rate, particularly when I'm saying about flexible interest rate, let's say, you are floating, if it is allowed. floating interest rate. If I look back last 25 years or 30 years or 20 years, if I see the interest rate within our economy, last 10 years, 20 years, 30 years, we have seen the long-term trend is it's declining. Now, if all of us believe that India is economy is going to grow like anything, we will be amongst the top 3 economies. We are going to become $5 trillion economy because we are the biggest consumer market and lots of positive developments are happening within our economy. That means the cost of capital will definitely get reduced, which is the interest rate. So let's say if I go for floating rate, and in all probabilities, after some years, the rate of interest which I'm going to pay will be lesser than what I started with. Now let me assume you are paying, just to give an example, let's say you are paying 20,000 when you started. As the interest rate decreased, maybe you end up paying lesser. So now you are paying, let's say, 18,000, just to give you an example. Now you have saved 2,000. What you can do? Let's say you have committed 20,000 for next 20 years or 25 years, which you are going to pay. Committed. But now since your EMI amount is getting reduced, which has now become 18,000, you are left with this 2,000. The wise move would be invest this 2,000 in a good equity mutual fund. And if I take 20 years period, and I just take the historical rate of return which has happened, and if I just look at it, what I'm going to expect, then you will see not only the asset which you have purchased, the value will go up, of course, but the 2,000 is going to give you more money than what you have total paid to the bank for the loan. That means it's a win-win situation. By a better loan management, not only I have created wealth for me in terms of a good investment, 2,000 rupees every month doing SIP, let's say for 20 years or 15 years, even if it grows at a rate of 15% or 20%, is I've accumulated it. On the other side, the asset which I purchased, that value has also gone up. And when I look at the amount which I have accumulated and the loan or the total EMI which I have paid, I will see the amount which I have accumulated is more than the loan or the EMI, total EMI which I have paid. So again, this is something which I want to help, or I would advise each one of you to look at it. And this will help you to grow your net worth as well as build a good asset also simultaneously. So I thank you all of you for this session, and I wish you all the good luck for your years and days ahead. Thanks to all of you.